Bay Street reaction. Royce Mendes is the managing director and head of macro strategy at Desjardins, and he joins us now. David was talking about this front-loaded plan, this strategy. Do you think this was the right move by the Bank of Canada, Royce?
I fully endorse the front-loaded strategy. It's something that we've talked about for a long time. The pace of rate hikes is not really what matters. It's the level of rates that matters, and rates have been too low for too long. So getting them up to a higher level sooner will help ward off some of the extra inflationary pressures. The issue that I have was the communication strategy, which was largely non-existent. We had no idea on the street that the bank was even considering a 100 basis point move, let alone going to conduct such a colossal rate hike.
And what's the significance of that?
Well, we've seen some large market reaction, and I think this will introduce some uncertainty about the Bank of Canada's reaction function moving forward. When things are going well, the market understands what the Bank of Canada is going to do with regards to certain data releases. And the Bank of Canada, if the market is not pricing in what they want the market to, the Bank of Canada will come out and communicate otherwise. In this case, the silence from the Bank of Canada was deafening.
Now, the bank governor, Tiff Macklem, suggested he is determined to eliminate inflation. You talked about warding off some of those inflationary threats. We could get into the nuances on the language, but at the end of the day, outside of how they went about coming to this conclusion and communicating this decision today, do you think they can be successful in bringing down inflation to normal levels?
I think they can be successful. I think the question is at what cost? And I'll leave that to others to quantify the probabilities of a recession. But what I can say is that from what I heard, it sounded a whole lot like the Bank of Canada governor was willing to engineer a recession if that's what was necessary to bring down inflation.
And just look, well, it sounds like you don't want to make a prediction on whether we see a recession, whether we're already in a recession, but just in terms of what's going to be the nuanced difference on how sizable a slowdown in growth we see. You know, people talking about soft landings and then talking about mild recessions. And then obviously, I think a lot of people, just given the environment right now, thinking of the Great Recession, thinking of the financial crisis. And in that case, you're talking about a length that goes beyond the average downturn that we see. What do you think ultimately is going to determine the path that we're on?
I think a monetary policy induced recession, so long as it doesn't come with some unforeseen shocks, say, for example, in the financial system, would be relatively modest and likely reversible, because you can always dial back the number of rate hikes. But more and more, it seems like we are taking the steps towards that type of slowdown in the economy. At first, you know, we had the Bank of Canada coming out large with stimulus, and probably too large with regards to its quantitative easing program. Then rates were left too low for too long. Now what we're hearing is we're at 2.5% on the overnight rate, and we're going to need to go higher. The question is whether this is another case of the Bank of Canada being behind the curve, because we are starting to see already some signs of slowdown. You know, I think you alluded to the job losses, the slowdown in the housing market, and some cracks forming in consumer spending. I wonder whether the Bank of Canada is going to be slow to recognize how much impact it's actually having on the Canadian economy.
I do want to come back to that point, Royce. Obviously, one of the key differences between our housing market today and, let's say, going back to the financial crisis is the current level of prices for a home, but the sheer amount of debt that Canadians have taken on over the last decade plus. So what is the downside worry that you are watching with our housing market, especially if we're, you know, in a interest rate hiking cycle? You're seeing the U.S. do it, other central banks around the world, but in terms of our household indebtedness, that is a key consideration as we watch what happens from here.
It means that every rate hike that we conduct here in Canada is probably 50 to 100% more powerful than it is, let's say, in the U.S. So 100 basis point rate hike all in one go is huge. And now we're at a level of 2.5%. I would argue that we are very close, if not already in restrictive territory. The housing market, as you mentioned, is dealing with very high prices and a run up in prices that could easily reverse itself. But it's also a much larger share of the economy than it was in decades past. It represents roughly 10% of the economy. If you look at a place like the US, that number is only 5%. So any slowdown in the Canadian economy that comes via housing is going to be that much more. And we know that monetary policy works first and foremost through the housing market. So we should fully expect that this is only the tip of the iceberg that we've seen with regards to the slowdown in housing, especially with the 100 basis point move today.
And at the end of the day, with this move now in the books, and you talked about the delicate balance going forward, we got inflation numbers in the U.S. today. Some thought inflation may have peaked in the U.S. It has not, based on that data. We'll get our latest data next week. But what part of this inflation story is something that the Bank of Canada will struggle to control, even with these aggressive rate hikes?
Well, obviously, it's going to do nothing for global energy prices. Fortunately, those seem to be coming down along with other commodity prices. It'll do nothing for the supply chain disruptions that seem to be very persistent. And it'll do nothing for U.S. demand. You know, part of the inflation problem in Canada is that we live very close to the U.S. economy, and fiscal stimulus was extremely generous there and drove a lot of the North American inflation, at least the excess inflation. So the Bank of Canada will struggle to control a lot of components in inflation. But what it can't control is domestic demand, spending on goods and services, and housing here. And that's where I think they will be focused. And I think that they're going to see a response from the housing market that is larger than they currently anticipate. And that's why I wonder whether forging ahead with even more rate hikes after today might not necessarily be the right move and eventually might need to be reversed.